Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
You probably don't know their name, but if you live in North America, there is a 33% chance that the medications sitting in your cabinet right now pass through their hands.
Yeah, it really is a staggering statistic. I mean, we interact with the healthcare system constantly, right? Yet this massive logistical engine that's, actually powering it, it remains almost entirely invisible to the average patient.
It's crazy. And welcome to another deep dive. Today is Tuesday, May 26, 2026.
Glad to be here.
And our mission today is to, well, pull back the curtain on that very engine. We are analyzing a company that effectively acts as the central nervous system for North American healthcare, McKesson Corporation.
Ticker symbol MCK.
Right. We're looking at how a middleman, basically a wholesale distributor, somehow evolves into one of the most powerful, freely valued entities in modern medicine.
Yeah, if you are analyzing business models, just, looking for structural advantages, this is basically a masterclass.
Definitely. And to unpack all of this, we are pulling from two really exceptional sources today. First, we have a fresh, incredibly detailed research report from Compasscope.
Such a good report.
Right. And we are analyzing that alongside the raw transcript from McKesson's Q4 2026 earnings call, just to get the actual word from the executives. So, what does this all mean? Let's dive in.
Let's do it.
According to that Compasscope report, McKesson distributes a third of all North American pharmaceuticals. Which, that scale is difficult to even visualize.
Oh, it's massive.
But I like to think of them as the Amazon Prime of healthcare, but for, highly sensitive, temperature-controlled, billion-dollar specialty drugs.
That's actually a really good way to frame it, but
Right.
but it's not just a simple warehousing operation anymore.
Right. So how is the actual business architecture set up? Because it's a beast.
It is. They operate through four distinct massive pillars. The foundational one, like you said, is the North American Pharmaceutical Distribution segment. Exactly. This is their volume engine. They are moving branded, generic, and specialty drugs to, chain pharmacies, independent retailers, hospitals, clinics, everywhere.
But I mean, moving boxes, even the really sensitive specialty drugs, that only captures a fraction of the value chain. So what are the other three pillars?
So the second pillar shifts them away from just distribution and into actual care delivery. It's their oncology and multi-specialty platform.
Wait, so they are actually involved in the clinical side?
Very much so. They operate the U.S. Oncology Network, along with these massive recent acquisitions like Core Ventures and Prism Vision.
Okay, just to clarify the mechanics here for everyone, they aren't just supplying these clinics with drugs, right?
Yeah.
They are functioning as an MSO, like a management services organization?
Yeah, that is the critical distinction here. As an MSO, McKesson actually handles the practice management, the revenue cycle operations, the clinical support for all these community oncology and retina practices. They are deeply, deeply embedded in the business of the clinic itself. They even run a proprietary data platform called Ontada.
Ontada.
Yeah, and it takes real-world, in-office dispensing data and literally feeds those insights back to the biopharma companies.
Which creates a really powerful feedback loop.
Exactly.
Okay, so that brings us to the third pillar, which sounds entirely removed from physical logistics, right? The prescription technology solutions, or RxTS.
Right, the RxTS segment is purely digital. It's software. And McKesson software is connected to over 50,000 pharmacies and more than 1 million providers.
1 million providers using their software. That's absurd. What are they actually doing with it?
Their primary function here is automating patient access workflows. So specifically handling benefits, verification, and prior authorizations for over 650 biopharma brands.
Which is wild because prior authorizations are like the absolute primary bottleneck in the entire healthcare system.
Oh, without a doubt. It's a huge pain point.
So by monetizing the software that clears that specific bottleneck, they are capturing high-margin tech revenue, not just, low-margin logistics revenue.
Yeah. It's a highly profitable choke point to control. And then finally, the fourth pillar is medical surgical solutions.
MedSurg.
Right, which supplies equipment and technology to non-acute settings, like ambulatory surgery centers. Though we should definitely note that they are actively in the process of carving this unit out into an independent entity.
Right, which we will get into.
Yeah. But what's fascinating here is, well, McKesson doesn't just distribute the specialty drug, right?
Right.
They own the software that secures the insurance approval for it. And they manage the clinical network that ultimately prescribes it.
Okay, let's unpack this. because controlling the distribution, the clinical management, and the software approval pathways, that gives them massive leverage.
Huge leverage.
But they aren't alone. I mean, the CompassScope report outlines a very tight oligopoly. Like, McKesson shares over 90% of the U.S. pharmaceutical distribution market with two other giants.
Cencora and Cardinal Health.
Exactly. So if there are three players with roughly similar scale doing essentially the exact same thing, how does McKesson actually sustain a competitive advantage? Like, how do they win?
Well, their economic moat is built on two very specific foundations. The first is what analysts call a structurally negative cash conversion cycle.
Okay, if you're looking at this from an investor's perspective, a negative cash conversion cycle is essentially the holy grail of working capital. Break down the actual math of how they achieve that.
Sure. So it comes down to the velocity of money. McKesson collects cash from their pharmacy and hospital customers significantly faster than they actually have to pay their drug suppliers.
Oh, wow.
Yeah, for example, they might deliver a massive shipment of specialty drugs, collect the payment from the pharmacy within, say, 15 days.
Okay.
But their negotiated terms with the pharmaceutical manufacturer allow them to wait 30 or maybe even 45 days before actually cutting the check.
Okay, so for those 15 to 30 days, that cash just sits on McKesson's balance sheet.
Exactly. And when you are moving $400 billion worth of product annually, that short-term float generates just massive, continuous liquidity.
That is wild. It's essentially a self-funding operational model.
It really is. They don't have to borrow heavily to fund their daily operations because their suppliers are basically unintentionally financing it for them.
Right.
And this dynamic is a primary driver behind their return on invested capital, or ROIC, sitting comfortably in the mid-30s.
In the mid-30s, that explains the financial leverage right there.
Okay,
so what is the second foundation of their moat?
institutional stickiness through these massive mega relationships.
Sticky is good. Like, what kind of relationships?
Well, they establish joint ventures and long-term contracts that are just incredibly difficult to unwind. The best example is their joint venture with Walmart.
Okay.
It's called ClarusONE. And this entity centralizes the purchasing of generic drugs for both companies.
Oh, which aggregates massive volume.
Exactly. It gives them unmatched negotiating leverage over generic drug manufacturers. But they also have this deeply integrated long-term contract with CVS that runs all the way through 2029.
But, okay, let's play devil's advocate. How wide is that moat, really? Because if I'm looking at the broader healthcare landscape, the real threat to McKesson isn't Cencora or Cardinal Health.
Right. Who is it?
It's the vertically integrated pharmacy benefit managers, the PBMs. Because if, United Health's OptumRx or CVS Caremark already control the formularies and the benefit designs, they have the sheer capital to just bypass McKesson entirely. Like, they could build their own specialty distribution warehouses.
Yeah, and the data backs up that concern completely. That is the existential threat to the traditional wholesale model.
Right.
These vertically integrated PBM giants are increasingly looking to insource specialty pharmacy operations. They want to capture more of that value chain.
Which makes sense for them.
It does. And if a PBM decides to cut McKesson out of a highly profitable specialty niche,
Right.
well, the volume loss is significant.
Which means McKesson can't survive just by pushing more boxes. If United Health can build a warehouse, McKesson has to fundamentally change the economics of what they're moving.
Exactly.
And that transitions us perfectly into their growth strategy. Because when you already control a third of the market, you can't just magically invent more patients.
Oh, no, you definitely can't. So their strategy has aggressively shifted from just chasing sheer volume to really optimizing for margin.
Okay.
They are focusing their capital on the fastest growing, most profitable segments of medicine right now.
First on that list has to be the explosion of specialty therapies and GLP-1s, right? The diabetes and weight loss drugs.
Oh, absolutely.
Yeah.
The handling requirements for those, the temperature controls, the specialized tracking for these complex therapies, it allows McKesson to command completely different service fees.
Compared to just moving massive pallets of traditional generic pills.
Exactly. It's a whole different ballgame.
And the second lever of that margin strategy is the massive expansion of that MSO oncology platform we discussed earlier, right?
Yes. They are executing a really rapid roll-up of independent practices. Like, they recently integrated Florida cancer specialists via their Core Ventures acquisition.
Right.
And by bringing these massive community oncology networks onto their proprietary management platform, they are targeting a 13 to 16% long-term operating profit growth rate, just in the oncology segment alone.
Just in oncology, that's huge. And I'm guessing that ties directly into the third growth engine, which is the RxTS software segment.
You got it, because moving atoms, physical drugs is expensive and logistically heavy.
Right.
But moving bits data for prior authorizations that commands premium tech-enabled economic multiples.
I feel like they are systematically decoupling a massive freight train, like dropping the heavy, low-margin cars so the engine can pull a lighter, far more profitable load.
That structural analogy is incredibly accurate. We actually saw this when they completely exited their European operations.
Right, they just closed that out.
Yeah, officially closing out with the sale of their Norway business. And it is exactly what they are doing by carving out the medical surgical business right now.
So they are shedding the lower growth assets to redirect basically all available capital into oncology and healthcare technology?
Yes, and that capital reallocation is ruthless. I mean, they are utilizing the massive free cash flow generated by this portfolio simplification to fund aggressive shareholder returns.
Like buybacks.
Huge buybacks. They are targeting 13 to 16% long-term adjusted earnings per share growth, and that is heavily supported by a newly authorized $5 billion share repurchase program.
$5 billion?
Yeah, planned just for fiscal year 2027. By retiring those shares, they artificially amplify the earnings power of every remaining share on the market.
It's a highly engineered financial strategy, but, restructuring a global logistics network comes with profound execution risk. You can't just uncouple a freight train while it's moving at full speed without risking a massive derailment.
You really can't.
So what are the structural cracks in this master plan? What could go wrong?
Well, the Compascope report zeroes in on a pretty glaring vulnerability, which is extreme customer concentration. We mentioned their long-term contract with CVS earlier.
Right.
CVS alone accounts for roughly 24% of McKesson's total consolidated revenue.
Wait, almost a quarter?
Yes. And their top 10 customers combined make up over 70% of their total sales.
Nearly a quarter of a $400 billion business relies on a single customer. That is terrifying.
It is. If CVS decides to squeeze them on pricing during that 2029 contract renewal, or worse, decides to internalize more of their logistics network, that is a catastrophic revenue shock.
Yeah, the leverage in that relationship is very delicate. What else?
Another immediate risk is the sheer logistical complexity of the medical surgical carve-out. McKesson recently brought in Apollo Global Management for a 13% minority stake.
Oh, okay.
And that deal valued that specific MedSurg unit at $13 billion. And they are now prepping this independent entity for an IPO.
Which, requires standing up an entirely new corporate infrastructure. They have to untangle decades of integrated IT systems, establish all these transition service agreements, structure billions in new term loans.
Yeah.
And they're doing all this while executive management is simultaneously trying to integrate massive oncology acquisitions on the other side of the business.
It is a massive bandwidth drain for the executive team.
I bet.
And overshadowing all of this is the persistent weight of industry litigation and regulation. Like McKesson is currently executing a $7.4 billion opioid settlement payout, which is structured over 18 years.
$7.4 billion. And that isn't just an accounting charge. That is a literal recurring drag on their free cash flow that they basically have to outgrow every single quarter.
Correct. It's real cash out the door.
Yeah.
And looking forward, there is the ever-present threat of federal drug pricing reform.
Right.
Which could directly compress the margins on the very specialty drugs that McKesson's relying on to drive all this future growth.
Right. Okay, here's where it gets really interesting. Because we have a company executing this highly complex transition, they're leaning into high-margin segments, but facing massive customer concentration and regulatory risks.
A lot of spinning plates.
A ton. So how did this actually hold up in the real world last quarter? Because looking at the Q4 2026 earnings transcript, the financial engineering seems to be working flawlessly.
Yeah, the fiscal year 2026 results were just exceptional. Consolidated revenues broke the $400 billion mark. They landed at $403 billion.
Wow.
And crucially, their adjusted earnings per share grew by 18% for the full year. So they handily beat their own long-term targets.
I want to focus on the GLP-1 dynamic for a second because it highlights exactly how their business model insulates them. On the call, management noted that McKesson distributed $14 billion worth of GLP-1 medications in Q4 alone.
In a single quarter.
Right. That represents a 22% year-over-year increase, $14 billion in a single quarter for one class of drugs.
The sheer volume is historic. But, the most revealing insight from the CFO's commentary wasn't actually the year-over-year growth.
What was it?
It was the sequential performance. From Q3 to Q4, GLP-1 revenues actually declined by 4% due to supply constraints and just broader market dynamics.
Right, but the transcript shows that 4% revenue drop had zero negative impact on their operating profit, which is wild. How does a distributor lose hundreds of millions in sequential revenue without taking a hit to the bottom line?
Right, it exposes the mechanics of their manufacturer contracts. McKesson has successfully negotiated fee-for-service models for these specialty drugs.
Oh, okay.
Yeah, so they are compensated for the complex logistics, the cold chain storage, the data, reporting all these services that retain their value regardless of minor fluctuations in the underlying drug's list price.
Or temporary volume dips.
Exactly. Their margin structure is effectively insulated from raw revenue volatility.
And they are backing up that margin protection with massive investments in operational efficiency. Like CEO Brian Tyler spent a pretty significant portion of the call highlighting their new state-of-the-art distribution center in Montreal.
Oh yeah, the Montreal facility.
They have deployed advanced AI-powered storage and retrieval systems utilizing actual robotics. They are shifting the entire network from just like reactive inventory management to predictive AI-driven planning.
And we saw the tangible ROI of that technology this past winter. I mean, think back to January of 2026. Severe winter weather gridlocked transportation networks across 20 states.
Oh, right. It was a mess.
Historically, that kind of supply chain shock would severely compress a distributor's quarterly margins, just due to expedited shipping costs and lost inventory.
The earnings report showed absolutely no material impact.
Because McKesson's predictive risk monitoring allowed them to dynamically reroute inventory ahead of the storms. It proves that at their scale, technology isn't just an efficiency tool. It is an operational fortress against macro disruptions.
A fortress that, we should definitely note, was heavily architected by their outgoing CFO, Britt Fight-Alone. The Q4 call actually served as his sign-off after 20 years with the company.
Yeah, and his tenure is a literal case study in capital allocation. The CEO noted that during Britt's time as CFO, McKesson delivered an excess of 500% in total shareholder return.
500%.
Yeah, that translates to roughly a 20% annualized growth rate over his entire tenure.
Which, for a mature wholesale distributor, that kind of compounding growth is incredibly rare.
Very rare.
But his retirement means a legendary capital allocator is exiting right as the business is undergoing its most complex portfolio transition yet.
Yeah, the timing is definitely something to watch.
So if we are analyzing this company's trajectory over the next, say, 12 to 24 months, what are the critical indicators to watch?
Well, if we connect this to the bigger picture, there are really three specific wildcards that will dictate whether McKesson can sustain this premium valuation. The first is the long-term impact of the Inflation Reduction Act, specifically the Medicare price negotiations.
Right. And they mentioned on the call that they navigated the first wave of IRA pricing without major margin compression.
They did. But as the government targets a broader list of high-cost specialty drugs, the real concern is whether the manufacturers will try to claw back margin by squeezing the distributor service fees.
I see.
Yeah, that tension between manufacturers and distributors, that will be the defining battle of the next decade.
Okay, so IRA is wild card number one. What's number two?
The second wild card is the accelerating wave of biosimilars entering the market, specifically in the community oncology space,
Okay.
which falls under Medicare Part B, covering drugs administered directly by a physician in a clinic.
Intuitively, though, you might think cheaper biosimilar drugs replacing expensive branded biologics would actually hurt a distributor whose revenue is tied to the volume of dollars moving through the system. Like, cheaper drug, smaller cut.
You'd think so, but it's actually the exact opposite. On the call, management referred to biosimilars as a win-win-win.
How so?
Because biosimilars are fighting to steal market share from entrenched branded drugs, right? So the manufacturers are willing to offer massive rebates and favorable spread pricing to distributors who can actually move the needle on adoption.
Ah, the mechanics become clear. Because McKesson operates that massive MSO network managing these oncology clinics, they have the direct clinical pathways to quickly guide physicians toward adopting those specific biosimilars.
Exactly.
They use their clinical influence to drive market share, and they capture premium margins from the manufacturers in return.
You nailed it. Their ability to leverage the clinic to drive the distribution margin is the core thesis of their entire oncology strategy.
Wow. And the final wild card.
The final wild card is the execution of the medical surgical IPO. The market will be watching very, very closely to see how cleanly they disentangle the IT and debt structures.
Right.
And of course, how aggressively they deploy the billions in IPO proceeds toward that massive share repurchase program.
It is a high-wire act of capital reallocation, that is for sure. So, to synthesize what we've covered today, McKesson has entirely transcended the traditional definition of a wholesale distributor.
They really have.
They are a financial engine exploiting a negative cash conversion cycle. They are a healthcare technology firm monetizing the prior authorization choke points. And they are an expanding clinical network directly managing the business operations of community oncology.
They have essentially embedded their infrastructure into the actual financing, authorization, and delivery of patient care itself.
Which brings us back to that invisible system we discussed at the beginning. The next time you pick up a prescription or sit in a clinic, consider the layers of software, the predictive algorithms, and the financial float operating quietly in the background.
It's everywhere.
It really is. And as McKesson continues to deploy AI into their supply chain and automate the software that dictates benefits access, it leaves you with a pretty provocative question to consider.
What's that?
In the near future, will the specifics of your patient care be determined by the physician sitting across from you or by the algorithms of the invisible distributor routing the prescription?
Wow. Yeah, it is a structural shift in healthcare authority that we are all going to have to navigate.
Absolutely. Thank you for joining us on this deep dive into McKesson. Keep questioning the invisible systems operating around you, and we'll catch you next time.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.